Hey everyone, my name's Andy. My channel is Finding Value. Today we're going to go over a question. I think it's a good question. And I'm going to tie two questions together and answer a whole bunch of different stuff in this one. So definitely check this video out for the whole length because I'll go over and cover a lot of different viewpoints here. At least they're all my viewpoints, obviously. I'll give you my opinions here. I'm going to start with one question and add to it. The question is in the comment section. I'm just going to read it to everybody. It says, Andy, wouldn't the safest play be just to buy these commodities after the overall market sells off and bottoms out? Back in 2000, the commodities didn't have a bull run until after the bear market of the S&P and NASDAQ. I think that's a really strong, legit question. The other one I'll add into it, and I will answer that question, is the second portion is how do you play the bull market? What kind of strategies? How do you look at it? And I've covered it a little bit before, but I think a lot of people are asking questions about those two types of things. I'll give you my opinion here. We're going to dive in a little bit. And I'm first going to go over and try to describe some stuff using some charts, because charts are, it's not about the technical analysis. It's not about the chart patterns per se. It's about recognizing the paradigm shifts in the market. And the one thing I want to go over with paradigm shifts in the market are yields. And what's important for investors to understand are yields. All right. So the reason it's important to understand yields and what they're doing and the environment that you're in is it determines money flows. When I say that I look deeper, you've heard me say this last technical analysis. I say I look deeper than the charts themselves. And what I'm trying to do is I'm trying to see if we're going to get a turning point out of interest rates. Why is that such a big deal? And what are interest rates telling us? And why are interest rates so important? Interest rates and the people who trade in the bond market are supposedly the smartest investors, most educated, most in the well-know of the markets. It's lots of banks, lots of hedge funds or trading desks or whomever. They're trading these things left and right. The resultant outcome of the interest rates or yields basically is their opinion on the market. It also reflects the pricing of all other assets in the world. So the interest rate is put into net present value calculations to calculate future growth discounted backwards given a, quote, risk-free return from treasury bonds. So as interest rates go up, the growth in the future of companies is discounted back with a higher interest rate. What that means is that PE ratios, the price to earnings ratios, will shrink in an increasing interest rate environment. Those net present value calculations go down. When they go down, people are less willing to speculate into stocks, more willing to take the higher interest rate on the bond, especially if interest rates are at high levels. So they're far less willing to speculate if you've got an interest rate on a bond at, say, 8, 9, 10% than they would be at 1 or 2%. So really, it's guiding money flows to some degree. Now, what causes interest rates to go up and down? Interest rates going up and down are the inflation or lack of inflation in the system. Higher rates of inflation put a real negative yield on bondholders. They're losing purchasing power, and people say, you know what? I don't like the situation we're in. I don't want to lose purchasing power, and they sell their bonds. And that selling then leads to more selling as interest rates go up and the principal of existing bonds goes down. You're losing your principal. So you're losing money in bonds as interest rates go up, and that interest rate is pricing all of the assets in the world. And as bond prices have been in a 40-year bull market in prices because interest rates have fallen for 40 years. And that is what this whole chart is. It's declining rates. As yields go down, the interest rate goes down, bond prices go up. And what I was looking for, even back in 2016, was a turn in this yield here and a breakout of this long-term trend line going down to an uptrend line. This is where your technical analysis comes handy. I was looking for it because what we saw was commodities were so cheap to stocks. And stocks are starting to top out and roll over. What I'm trying to say is that they are all interconnected. So in order to kind of understand the importance of all this, you have to first understand that the smartest investors are selling bonds in mass, and we're getting an increase in yields. This is what prices assets out in the world. Now, everyone's saying, well, we're going to get this crash. Why don't we just wait till after the crash? Well, in 2000, which is this portion here, here's 2000 where I'm circling it right there. What did we see? We saw a decline in interest rates. What does that mean? What it means is people were scared in the system of a crash. And what they did is the smartest investors in the world bought bonds and yields went lower. They knew a crash was either happening or was about to happen. So people positioned, the smartest investors positioned before the move, and then we saw a move lower in yields. They were buying bonds as the stock market went down. Yields went down. That ended in 2004, and we saw a nice little move all the way up to about 2008. And then the crash happened in late 2008 here, but bond investors positioned themselves before the crash. Before the crash. So yields went lower before the crash happened. So let me go over that one last time real quick, all right? Yields in 2099 were going lower. People were positioning in yields. People were positioning in yields before the crash in 2008. What both of those crashes have in common is people were positioning in bonds here and here. They were buying bonds because they knew a crash was going to come. Now, people say, well, why are you staying long in commodities? Because there's a recession or crash coming. This is why I'm staying long. If you look at the yields here, what do you see? You see a resistance line and you see yields rocketing higher. Well, the smartest investors are selling bonds like no other. If the smartest investors are selling bonds, what signals are they telling you and me? They're saying, look, we've got a problem ahead. I'm getting the heck out of bonds. If they're getting out of bonds, what does that mean? They think inflation's going to get worse than what it's going to get better. And what's the biggest inflation hedges in the market? Oil, energy. Now, what is causing this inflation? I'm a guy who has an engineering background, and what I do is I do root cause analysis. What people do is you don't want to try to fix symptoms of a problem. You want to attack the root cause of the problem. So the question that I'm going to pose for everyone here, what is the root cause of this going up? And I pose there are two root causes for this event. There could be more, but there's two major ones. At least in my opinion, there is. There's the money supply growth that went into where they just stimulated like heck. They got that all out into the system, and there's a lot of money in the system sloshing around. That is problem number one. What that does is it puts everything into a shortage. Inflation is an increase in the money supply in relationship to goods and services. There's too much money chasing too few goods. Now, here's a problem. if you don't have an increasing economy and you have too much money in the system, what that means is you've got supply constraints in the system and a bunch of money chasing fewer goods. The goods can't grow in the system because of some constraint. It can be supply chain constraints. It can be energy constraints in the system. I think that we have an energy constraint in the system, especially amplified by Russia. Now, Russia has openly said that they will cut commodities out of dollar pricing, that they're going to not price their commodities in dollars and sell it in other currencies. And other countries are also jumping on that bandwagon. And what's going to happen is, as dollars are used less around the world, those dollars will come back to the United States, as the majority of dollars are located outside of the United States. And those dollars can come back to the United States as inflation. Dollars are a future repayment. And a future repayment is looking for something to buy. It can be real estate. It can be a business. It can be products. It can be goods. It can be services. It can be commodities. It can be anything that is considered final payment for a dollar. Final payment is not the dollar itself. A final payment is a good, a service, an asset, or something on the likes of that. Now, that is all changing in the background, and it's positive for a long-term breakout of this interest rate to move higher. It's the changing of the tide, so to speak. So there's a few things that can change basically this new shift to an increasing rate environment. One of them is a larger demographic coming into home buying years, which is inflationary because the credit supply grows. Another thing that can happen is your system gets too in debt. You have to print a lot of money to cover those debts. And if there's any sort of problem in the supply of goods and services, you're going to see an amplification of inflation where people are not going to want to hold bonds. I think it's a combination of multiple things, but the ones that really stick out in my mind is debt, the millennials coming to home buying years, which is a demographic-driven event, and then you also have energy constraints in the system or supply chain constraints across the board. It's a combination of all those things. What makes me uncomfortable is people are calling for a crash when interest rates are basically rocketing higher. I think they're too early. They're too early because smart money is selling their bonds. They're not buying it. And we can see that in this chart with the interest rates going up. I am comfortable holding my inflation type investments and uranium and energy and commodities and precious metals because the interest rates are heading higher. The money is selling out of bonds, and the smart money is getting out of bonds. Now, before those two crashes, smart money was buying them, and what we saw was a decline in those interest rates in 2007 and 2000 and the decline before it. So there's a couple of major takeaways here that I want you to have. Interest rates are going up, bonds are being sold off, and that is nothing like the period before 2007, nothing like the period before 2000. Those are two very distinct differences where smart money selling bonds versus smart money buying bonds. And that's a huge distinction. Now, if I think we're going to see a crash, we could go up, put some sort of top in, head lower, then that's where you need to worry. I'm not worrying because smart money is getting out of Dodge in the bond market. We're seeing this large shift. Now, if I get that wrong, I can hedge myself with time. I bought the bottom of this thing pretty dang good. So I'm buying in here, I'm buying in here again on any type of pullback, and I'm holding for the big move. The big money's made on the big move. That is my strategy. Does my strategy mean I'm right? So far, I've been pretty dang right. But I don't know the future. Anything can happen. But with the smart money selling out, I'm going to bet with them. That's my take on it. So my strategy is looking out 5 years from now and saying, well, I don't care if we have a short-term necessary recession. I know the market balances in the market are pretty jacked up. Market balances are when you look at the demand, you look at the supply, and there's far more demand than supply out 5 or 10 years from now. What that means is that you're going to run into deficits. As you run into deficits, it's going to eat through your inventories. As your inventories decline to certain critical levels, price becomes the deciding factor of who gets what. It's basically the inventories become rationed by price. The most raw data that you can have in the market is looking at inventories of commodities, because that is the resultant of supply and demand. Supply and demand balance out through inventories. If you're building inventories or if you're drawing from inventories, basically tell you two different market conditions. If you're building inventories up, you've got more supply than you have demand. If inventories are being drawn down, you have more demand than supply. At some point, when they get to critical levels, price starts to skyrocket. We've seen that in rhodium and palladium as they increase the loadings into catalytic converters. And as they increase those loadings, we got into a very tight market. Inventories ran way down. And palladium in 2016 was $650 an ounce and ran to $30,000 an ounce. That was rhodium. Rhodium did that. Palladium went from a very low number in 2009, $200 and something, $200, all the way up to about $3,000 from 2009 all the way to 2020. That is the market going into deficit and then inventories running out and then continued deficits where price was the rationing factor. So those are two examples. Now, what's coming up ahead of us I'm seeing a market deficit in everything. That's commodity related. It's maybe not everything of everything, but a lot of things. Copper, nickel, zinc, tin, oil, natural gas, maybe, uranium for sure. You can keep going on and on and on at a lot of different things. Platinum, silver, gold. We're also seeing things roll over in terms of production. The signs of all of these are basically at the beginning of bull markets. We always see these same signals. We always see these same drawdowns of inventory. We see all of this. Now, the question I have is, if you know they're good and you have a very good position that you've built over this past 2 years, you could be up many times. There are a lot of positions I'm up in over 10x. I have 10 times my money. I put 10 grand in, it's now 100 grand or more. Some of them even larger than that have gone up 20, 30x. I'm not here trying to brag. What I'm trying to say is if you catch a good entry point and all of the conditions are still ripe for that to exist and you don't see smart money rotating, there's no reason for me to get out of that position. If I sell that position, what am I going to go into next? What is my next biggest investment? So what I'm doing is I am continuing to add on pullbacks that rest on support. That is a strategy that I am doing that I think works well. I'm taking a long-term time horizon and I'm saying, okay, if this is the next big shift, what does it look like 5 or 10 years from now? Well, we see the market deficits out in the future of commodities. What does that mean to the overall market? And what are the conditions going to be 5 or 10 years from now? Well, I think commodities are going to get very tight. They're going to go up in price. And we've got a debt problem. And we've got a lot of money in the system. That's not a good mix, guys. That is not a good mix. What that means is we have a lot of money in the system and we're going to be very supply constrained. Money in the system chasing fewer goods and services. You've got inflation. You've got the epic recipe for inflation. Now, what you're trying to do, if you're trying to sell and time this market, is you're really trying to time the market. And I'm going to tell you this, you do not have control over the markets. You are at their whim. You can't turn it. You can't wish it to go higher. You can't wish it to go lower. What you can do is you can identify what you got in front of you. You can identify the market conditions and how they're potentially going to change for a favorable price environment for commodities out in the future. It very much ties into interest rates. As interest rates go up, less of what used to work is going to work in the future. So what does that mean? As interest rates go up, bonds will continue not to work. It's an inversely correlated. Bond prices lower, yields higher, so they won't work. Money's going to rotate out because now people are losing money in bonds. And that's going to kick off a paradigm shift in what people believe to be working and not working. We're starting to play with the psychology of people now and how fast this money starts to rotate and move, and it takes time. Stocks may not work very well in this environment like we've seen in these long periods of time. And what I mean by that, I'm going to go and show you what the S&P 500. Now, if you were to tie these interest rates together and take a big, long picture view look at this, I'm going to go logarithmic here, guys. You're going to see these periods where stocks did nothing. They did nothing for a long period of time. And what I did is I went back and I looked and I said, why did these stock markets do poorly? Some of them had crashes. This was a huge bubble of everything in the 1920s. The 1920s had a big real estate bubble and it crashed and caused a whole bunch of defaults in the system. This was a huge problem in the system. And guess what? It mirrored very much the same as this period here. It wasn't perfectly the same, but it mirrored it. We had a bunch of bad loans in the system and they all went bust here and we crashed. That was a panic tied with a deflationary crash in that time frame. Now, the big overall pictures here is we had a commodity bull market in the 30s back here. Supply, demand constrained. We had the baby boomers coming up into home buying years, and it pushed this higher where we had, they call it demand pull inflation, where demand was wanting more and more and more, and we had an M2 money supply growth. We had a big boom in real estate and a very high increase of interest rates, all from like this portion on, and it really started to peak in this circle here. So we had a large debt period here where they had to print, and this was the resultant of higher interest rates through that entire period. The interest rates going up into, I'll call it stratospheric levels, and the constraint in the system of energy in 1970 made this stock market go sideways. What we have is the same type of environment entering over here where they printed, and we have a constraint of energy on a global scale, which is obviously being amplified by the conflict over in Russia, because they're drawing back on energy worldwide. They're saying we don't want to sell our commodities for dollars or euros or any of that garbage fiat currency. They are attacking the currency system. And whenever you have these types of attacks or energy constraints, the stock market usually does poorly in it. You get these large consolidation periods over long periods of time, and commodities usually go ballistic, especially with that inflation and the millennials coming into home buying years. Is kind of a very nice alignment here. So what we're seeing are these large periods of sideways movement in stocks. There's no reason to be there, in my opinion, at this time. And you've got the increasing interest rate that's driving all of this. Now, this isn't crashing because there's inherent weakness in the market. I'm going to say that again. It's not crashing because of inherent weakness in the market. It's crashing because interest rates are going up and it's being discounted in net present value calculations where people don't want to speculate anymore. It is a bubble. It doesn't mean that this crashing lower does not mean that commodities are the problem. The problem is that interest rates were so low that this went to a level that was unsustainable at a very low interest rate. And when interest rates turn, you're going to see this continue to go sideways and consolidate, much like this period here And much like the 1970s, where we had an energy crisis in the beginning and it went sideways with increasing interest rates. Now, increasing interest rates, I'm going to go back to the interest rates and give you my opinion here. Now, we're looking at interest rates. We did the huge down breakout, right? Interest rates are not the driver of this. So when someone says, oh, wait for interest rates to kill everything, they're not the thing driving it. Interest rates are on the caboose of this train, in my opinion. Why do I think that? Well, let's get into it. We've been going down in this disinflationary period. This period was a decrease in the rate, not a decrease in total, a decrease in the rate of population growth. The rate of growth, not population growth. It's the rate of growth declined. It was a disinflationary time, and there was nothing to really spark a large, big move in this rate higher. I think that with the millennials and the amount of money that they printed, that this could spur a breakout, which it did. And the inflation in the system is now causing, quote, havoc on prices, the consumer price index, with that energy crisis in the mix. The underinvestment in energy, the problems over in Russia, Ukraine, the attacks perhaps on some of these currencies, it's all adding up. The debt in the system, it just keeps stacking, stacking, stacking. So as we break higher here, that money is going to, and the interest rate is going to cause money flows to rotate differently. And those money flows are going to seek assets that work. Assets that work. Now, what's going to work in this type of environment? In a highly inflationary environment, there's a few assets that work, but there are much smaller assets in size, the actual asset value. I think that commodities, because we have this problem, I think they're a cause to the problem. So energy, I think, will do very well. It's a very good inflation hedge. And I think precious metals will do well because eventually, out there a little ways, people are going to get worried about inflation and they're going to get worried about the currency and the debasement of the currency. So I'm positioning in precious metals, I'm positioning in commodities and energy because I think those are the problems. And they're the solution, or people think that they're a solution. I think money's going to run at these things because money has nowhere else to really run. In an energy-starved world or a commodity-starved world, do you think companies that that consume commodities and energy are going to do well if those prices are going up and they're more difficult to get? It's going to be a constraint on growth. So you want to go after what everybody wants: commodities and energy. That's how I view it. And if there's any sort of hiccup or problems in this, I think currencies are going to come into question. And if currencies come into question, then it's precious metals. What happened in the 1970s if we have similar market conditions? And I think this is a combination of 70s and 40s combined. The time frame and the timing of this is the 1940s with the high debt and the money printing and running real negative rates. It's much like the 40s in that respect. The energy crisis, which kicked off kind of in the beginning of the 70s, is much like it is today, but it's a global energy crisis. The 70s could be a small prelude to what's coming ahead. Why? Because we were constrained to only America. The gold market and a currency crisis back in that time frame was all constrained to America, which is a small country. It's obviously one of the largest economies, or is the largest economy in the world, but it was constrained there. Now it's global. It's global, baby. And global means you've got more money, more people all involved in this rotation of money across asset classes. We're super early to this mix. That's my opinion. And you can kind of tell if you listen to some of these people in governments where they're like, this is going to be a rough winter for the next 5 to 7 winters. I mean, they're projecting out half a decade plus in the toughness in the energy markets. And I'm hearing this across, multiple rulers, we'll call it, in Europe and whatnot. So I don't know if this is going to be a short-term little blip. I think it's going to take time to solve. And what I'm doing is I'm positioning for that type of market condition in the future. Remember, market conditions determine asset values. And what I did in the beginning is I used ratios to figure out where those values are best in the world. And the way that I did it is I took an approach basically from how would I value a car in 1950 if a car costs $1,000? Is that expensive or cheap? And then what you do is you go back and you value it against other assets, you value it against other goods and services, and then you would get a relative comparison. They do the same thing in real estate. They would benchmark, they call it doing their comps, comparative analysis. That's all it is. Those are all ratios. They're just looking to see, well, this house with this many bedrooms is the same as this one, and this is what it sold for. So it's going to be around that price. That's all they're doing. That's exactly what I did with all of my entry points. What really made me bullish on commodities in the beginning of this bull market was the ratios were so cheap. The ratio of commodity to stocks, the ratio of oil to anything. Oil to gold to oil ratio was the ratio that really got me going. It was over 100 at one point. Absolutely anomaly in history. I looked at it and said, I know I've seen this before. I'm going in big. And why did I choose oil and natural gas over the other ones? Because the leverage, the asymmetric move, and how cheap it was. And most of these companies have assets in place. They've got producing wells, and they are exploring and producing from their projects and from their land. So it was being priced because the commodity blew out to the downside. Some of them had debt, and that debt really blew them out to the downside where they were selling for pennies on the dollar. The infrastructure was in place, and it was the lowest risk, highest returning bet that I could find in the market, bar none, by a long shot. Some of these other mining companies don't have the infrastructure in place, and if you go into the market conditions that I think going forward, where you have high inflation and you have commodity constraints, it's going to be hard to build a mine at a low cost in that type of environment. So I've been very focused on energy-focused investments and producing royalties and those types of investments for precious metals, and the physical metals themselves I think will do incredibly well if there's energy constraints and commodity strains, because you're going to get even more supply constrained problems with your inputs being constrained. So that's kind of the outlook, the strategy, and why I continue to hold is because I don't see any reason to sell yet. I don't see any indications where yields are starting to basically uninvert, come back down, and have me see the positioning of smart money back into bonds. I just don't see it yet. So why would I position yet? Now, here's the difficult spot with commodities. I'm going to tell you flat out, they are volatile as heck. People get scared because of the volatility. They're very hard to hold on to. And what I'm doing is I'm going after the most volatile companies. Why? Because usually they have the largest returns. I'm not doing it just because of volatility. I'm looking at the fractal sizes, which is the DNA of the stock, to get me those big returns. I can risk less money, get greater returns, but I have to live with more volatility. That is the payoff is there. And that's how I got those big returns. That's how I'm basically filtering through my stocks. I'm looking at all the charts. I'm looking at the fractal sizes. And the fractals are much like your hand and fingers. If you have a big palm, more than likely you're going to have long fingers to that extent. So bigger palms generally have bigger fingers. Larger fractals generally have bigger moves in these stocks. And all of these big fractals and stocks, I teach that on the Platinum membership of the website. And now is a great time to sign up because you can figure out what the good companies are, which ones you might want to avoid, and which ones have the big fractals, how you position size and all that stuff, and how I've done it myself. I've made a good amount in some of these companies, and I'm going to continue to ride it, and I think they're still of good value. And we talk about different sectors and different fractals, different companies, cash flows, what's a cash cow, what's not a cash cow. The non-cash cow exploration companies are very speculative. Probably don't want to put a bunch of money in them because they're going to be one, very volatile, and two, it may not work out the way you think it's going to work out. They might not find anything. Carries a lot more risk. And if you're sitting at the beginning of a big, huge bull market, you don't have to sit in all of these super risky companies. You can drop the risk down, still get the majority of this large upside. And there's some companies that are producers, that are high cost producers with a little bit of debt, that are going to amplify this move to the upside, that are cash flow rich right now. Those are the ones we want. Those are the ones that are the cash cows that haven't been seen yet. That's the value. That's, quote, finding value. So that's the setup. That's why I don't think there's going to be a recession yet. I could be wrong, but I'm gonna hedge it with time. I'm gonna ride through it if I'm wrong. Why? Because all of the fundamentals out 5 years from now gives me the big picture to stay long. That's the thesis, the business cycle, that type of investment. Now here, I'll give you another something that's, I'll be completely honest here, guys. Commodities make their big moves right before crashes. They're the late cycle mover. This is the time where people get a little bit jittery. Now, people are getting jittery because interest rates are going up. People think that interest rates are going to kill the move. It could, and we'll have to see what happens. But the late cycle movers, they usually go vertical right before the crash, unfortunately. So riding these things can be quite difficult because the volatility, and they usually go ballistic right before a crash in the markets. Interest rates are usually going up. Interest rates, and what happens is interest rates moving up really focuses down the number of investments that work. A small amount of money rotation from these big assets into the smaller assets make them go ballistic. They push the trades up quite a bit. So retail gets sucked into it, and then they offload all their shares to retail. The reason I don't think that we're at the top is because the ratios are telling us that the money hasn't rotated into commodities in the quantities that they have in the past. So we are still relatively low on a valuation scale in relationship to other assets. We are still very cheap. Commodities are still very cheap in relationship to the S&P 500. What that looks like in a ratio chart here, which I'll bring up, is it looks like this. This here is a very low level in relationship to the upper level that we've hit in 2008. So we have a long way to go higher in this bull market. And this bull market's probably going to be pretty long. It's not going to be short. It's probably going to be like a decade or 5 to 10 years, something like that. So that's why I don't think that we are going to be selling. No one's selling. Well, I don't think people are selling here because of valuations. You're coming off 100-year lows, and we've come up a little bit, and people think that's crazy. We've got a long way to go, a very long way, and a lot of money potential could be made in this decade in commodities, in my opinion. And I'm spreading out amongst what I think are the best bets based off of the paradigm that I just described of an energy crisis, of potential currency problems, inflation, and the paradigm shift of money rotation away from currencies and bonds and into these assets. I mean, that's really what it is. And if you guys want to learn about this, you can obviously ask me on the Finding Value website with the Platinum membership. I can go over and through all of this. I can show you the companies I've got. And you can ask questions during these question and answer sessions we have on the weekends. So that is where that value is. And the value of the website is learning how to invest, coming up with strategies. And I'm not a short-term trader, guys. I don't think short-term trading is going to get me where I want to go, which is financially free for the rest of my life. I just don't think that's the path to do it. And even the best traders in the world lengthened their holding periods. So if the best traders in the world lengthen their holding periods to basically what I'm doing, what Buffett's doing, or Lynch, they went kind of to the max. Who am I to say that they're wrong and they're the best investors in the world? What Buffett and Lynch have done is they basically took the business cycle out of it. They said, don't worry about business cycles. I'll buy at these bottoms. These bottoms are these crashes between the business cycles. They load up like heck. And then they hold on forever, basically. And what they do is they span across multiple cycles. But if they have, we'll call it strong companies, if they have very strong companies that sell things that people want that don't really get designed or phased out, think of food companies, think of insurance companies, think of things like that. They hold on to these things, they buy a whole bunch, and then they just wait forever. So what they do is they wait for that entry point. They wait for a very good entry point. They load up like mad in those good entry points, and then they just hold on for a long period of time. That's how they do it. And they hold through any of these business cycles. They take everything out of the picture and they say, this business is undervalued. With time, it will be valued differently in the future. And then they just buy like heck. So they do all the upfront work. They buy it when it's cheap and they hold. That is their investing strategy. I don't know many strategies that work very well with your time frames compressed. I tried trading in and out in the last commodity bull market. Granted, I know far less back then than what I do now. But I mistimed a couple of things because remember, commodities are very volatile. I tried trading in and out of Ultra Petroleum, Chesapeake Energy. We had Aubrey McClendon running that. He was ultra bullish on natural gas. He got me ultra bullish because I'd listened to him. And he had a whole bunch of natural gas coming out his thing in the shale. So that was like the next big thing. And I rode it for part of it and I lost out on part of it. I didn't really know what I was doing and I held too long. I rode some down. It happened to me. I still made money, but there was a lot of mistakes I had. And that's what led to me figuring all of this out over time. And, technology has obviously helped me have access to certain data. I could do certain things that I couldn't do in the early to mid 2000s. So, all of this has transpired over the years of me investing, and basically the game has taught me the game. And I don't really listen to too many other people. It's really just me. The reason I listen to myself is because there's no reason to listen to someone else, because what they're doing is they're deciphering the data that I'm looking at. And I don't agree with some of the way that they decipher that information. I could obviously make some clips on what I disagree with and why I disagree with some of those other viewpoints. Some of them directly conflict with what I just told you, which is the smart money is selling bonds. They think a deflation's coming, and I see that as a mismatch. I think inflation's still coming. I think that the trade is still on because smart money is selling bonds and because interest rates are continuing to go higher. At some point, when the smart money starts to rotate and slow that interest rate down and roll over, I then become bearish. But between now and then, that could be a year or 2 or 3 ahead of us. We don't know that at this time. And a lot can happen in a year. Very big moves can happen in a year or 2. Entire bull markets have happened in a very short time frame. So the market conditions right now are very ripe for oil, natural gas, and uranium and these types of investments to go very, very much higher. Precious metals do very well in the back half. When you start to roll over on those interest rates and they kind of peak out for a little bit, that's when precious metals start going. And sometimes they go up even a little bit before that as people kind of front run it. So I do think that we're early, and I think that's also a good spot to be looking. So that's what I've got for today. Hopefully you guys made it all the way to the end. If you made it to the end, congratulations. This is 40-something minutes long. Definitely put in the comment section that let's put uranium to the moon, and hopefully that happens. Uranium to the moon. And definitely don't forget to click the thumb up, subscribe to the channel, subscribe to the website if you feel like learning more. But there's some of the reasons of why I am still holding and that I'm not buying after the recession, because we could entirely have a bull market before the next recession. We may have a short little recession that we've got already. I think it's being caused by increasing interest rates, and the driver of energy and increasing interest rates is what's bringing this lower. I do think that we could see further pressure and money rotation out of stocks and into commodities in some of these areas that we're in. All right, guys. That's all I've got. Hopefully you're having a killer day. We'll catch you next time. This is Finding Value.